Hi, I'm Steve LaFrance, and here's our October market wrap-up as we look ahead to year-end. Markets continued their upward momentum last month, with U.S. equities posting solid gains across major indices. The Nasdaq led with a 4.8% return, followed by the S&P at 2.3% and the Dow up 2.6%. Small caps cooled slightly, with the Russell 2000 rising 1.8% for the month, but still over 12% year-to-date. International remained strong, with emerging markets up 4.2%, while the developed markets added 1.2%, bringing both indices to over 27% and 33% respectively. The Fed cut rates by 25 basis points for the second meeting in a row in late October, bringing it down to a range of 3.75 to 4.0%. Futures markets now show a 60% chance of another cut in December, although Jay Powell emphasized that another cut in December is not guaranteed. Inflation remains sticky but stable, with core readings hovering near 3%. Break-even rates have eased slightly, suggesting that inflation expectations are moderating. Mortgage rates dipped modestly, with the 30-year fixed rate settling near 6.2%, down from recent highs. Earnings season was a bright spot. Over 70% of S&P 500 companies have reported, and 82% beat earnings estimates, well above historical norms. Mega-cap tech continues to dominate, with NVIDIA's $5 trillion market cap now exceeding the GDP of Germany. The Magnificent Seven stocks have returned 26% year-to-date, helping drive broader index performance. Still, valuations are elevated. The S&P trades at 26 times trailing earnings and 22 times forward, compared to a 10-year median of 20 times and 19 times, respectively. Sector performance was mixed. Tech led with a 6.7% gain in October, followed by healthcare and utilities. Materials, real estate, and financials lagged. This chart may appear a little random and messy, but I love it because it reminds us of the importance of diversification. Growth also outperformed value across all size categories, continuing a trend that's defined much of 2025. Fixed income markets were relatively stable. Treasury yields declined slightly, with the 10-year finishing near 4.1%. Investment grade and high yield spreads remained tight, and municipal bonds showed improving performance as supply pressures eased. Historically, rate cuts after a pause have led to positive returns in both treasuries and corporate bonds over the following year. With year-end approaching, it is a good time to revisit your portfolio allocations, rebalance concentrated positions, and consider your tax strategies. As always, we strive to stay grounded in process. Volatility is normal, but discipline turns noise into progress. So thanks again for your continued trust and confidence.